Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, May 8th, 2026. We're recording at 11 a.m. Eastern Daylight Time. This is episode 54 of the pod, and here is your starting lineup. Number 1, the natural gas market. Why is it stuck in the doldrums? Number 2, the inflation data. A reacceleration appears to be underway for U.S. inflation. And number 3, Cisco Systems. The survivor is now the thriver. So back to nat gas. We are bullish on commodities and have been for the past year. Why? Very simply, they perform in inflationary booms, and we think we're in one right now. The Bloomberg Commodity Total Return Index is up 30% year to date and is up almost 45% in the last year. This is clearly a bull market. However, natural gas is one of the only 2 commodities that is down in 2026, and it's down a lot. It's down 20%. Coffee's the other commodity, by the way, that's down this year. But natural gas appears to us to be a supply story. After digging into this with several people we trust and looking at all the production data, production growth is still very, very strong. Shale productivity continues to surprise on the upside. Demand is also very strong. It's strong for electricity, obviously to power data centers and clouds, and there's a lot of export demand. But we can only export so much natural gas due to capacity constraints. We need more LNG terminals. We need more trains. We need more capacity. Front month gas in the U.S. is just under $3 per MCF. In Europe, it's about $16 per MCF. That is a massive arbitrage. And while it's down in the U.S. 20% this year, it's up almost 80% in Europe. And obviously, this is a result of the Iran war. The Marcellus and the Permian basins continue to produce above expectations. The production in both of those major basins continues to grow. The Bloomberg data and the charts are really explicit on this and really lay it out clearly. Low natural gas prices, I think this is maybe the key point. Low gas prices in the U.S. are a great advantage and blessing for the United States. It lowers our cost to manufacture things. And while we have some of the highest labor costs in the world, we've got some of the lowest energy prices in the world. And that is really a great offset for the U.S. U.S. chemical producers now have a major feedstock advantage against the rest of the world, even China. So I think about this market and I think about the shoulder season. May is a shoulder season for natural gas. The summer weather will soon become a major factor for natural gas prices. And if it turns hot, these prices are going to rally a lot. If it's a cool summer, they'll remain in the doldrums. So that's the story on gas. Now on to inflation, where we received some really important data, the CPI and the PPI this week. And I think both of these data points just underscore a reacceleration for inflation is pretty clearly underway. It's clear to me, and it's becoming clear to the marketplace, that we have an inflation problem in the United States and around the world. This is not just a U.S. problem. This is becoming a global problem, and this problem was building before the Iran war. That's an important point. The ECRI future inflation gauge confirmed an upcycle a while ago, and the war has just compounded the inflationary upcycle that was already present under the surface. This week's CPI and PPI data releases simply confirm the upcycle for inflation. And as we analyze the data, and we like to dig into these data and see where the inflation is coming from. And in both pieces, CPI and PPI, the problem remains in core services and increasingly in goods. Of course, it's there in energy for the headline, but even taking that out, you really see it in services and goods. I think it's becoming clear the Fed did not raise rates high enough to lower services inflation and really get it down. And now that inflation is embedded in the U.S. economy. Global bond yields are rising, reflecting rising inflation. It's not just U.S. yields that are rising. The Japanese 30-year hit 4% for the first time in over 30 years. This is a global bond market sell-off. Stocks have been able to ignore inflation so far. Today is the first day that it seems a little bit different. Stocks are responding to higher bond yields. Interestingly, today is Jerome Powell's last day as the Fed chair. He was the chair for 8 years. And there are many things to admire about Jerome Powell. I think his legacy is going to be pretty complex. On the one hand, his legacy is likely to be in his valor in defending the Fed's independence, which I cannot underscore enough how important that is. And he showed great fortitude in that. But his legacy is also tarnished by his failure to bring inflation back down to the 2% target. He waited too long to hike rates in 2021 and 2022 and allowed inflation to get out of the box, and we're paying for it today. So a good man, a complicated legacy for Jay Powell here on his last day as the Fed chairman. And finally, Cisco Systems. The survivor is now the thriver. Cisco stock peaked in late March of 2000, the year 2000, at $82 a share. It is really hard to overstate the euphoria that was taking place around the internet at that time. And Cisco embodied all of that bullishness and all of that hope and all of those expectations. And John Chambers, the great John Chambers, who the longtime CEO of Cisco, was nicknamed the Pied Piper of the internet because he was always bullish, and most of the time he was right. And for a long time he was right. But this week, 26 years later, more than a generation later, Cisco stock finally made a new all-time high. We've got to salute that. Cisco reported fiscal third quarter 26 earnings of $1.06 per share versus $1.03 estimates. Ho-hum, a modest beat. But that was just on the surface. You dig down and you'll see, we listened to the conference call here, and the third quarter represented record revenue of almost just shy of $13 billion, up 12% year over year. And here's the key point: robust demand for AI infrastructure products. That is what is driving good financial performance by Cisco. Cisco guided fourth quarter 26 revenues, the next quarter, to $17 billion. That's a big jump. Hyperscaler AI orders are expected to be up 4.5 times in 2026. This just captures the staggering size of the AI CapEx boom that's going on right now. And I would guess that we're probably sweet spot of it. Gross margins for Cisco in the quarter were down 220 basis points because of memory costs. Market did not care one bit about that. The stock was up 17%. And here's a quote from CEO Chuck Robbins: AI is driving demand for networking, routing, compute, switching, optics, and wireless solutions. And Cisco sits right in the middle of all of those things. Operating cash flow decreased 7% in the third quarter as Cisco invests heavily to meet expected AI demand. And this is what's happening across tech. There is a lot of heavy investment, probably a lot of it good investment, but that is reducing cash flow. And that is going to reduce returns on invested capital. Now, Cisco is increasing hardware prices by 4 to 5%. I think that ties into our comments on inflation earlier in the pod. It's doing so to offset rising costs. A lot of these costs are memory costs, which we know are exploding. So Cisco is back in the sweet spot a full generation later. Congratulations to the ultimate technology survivor, now a thriver. So do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.